Albatrosses are birds, which are highly efficient in flight, able to cover great distances with little exertion. The birds can keep gliding for long hours without the need to land. India's economy and equity market are demonstrating similar characteristics to an albatross gliding. India's economy has progressed into a virtuous cycle with long runway for growth, abetted by reforms and a robust banking system. Simultaneously, corporate India's balance sheets have significantly deleveraged and efficiency is likely to improve. Earnings growth has been healthy over the last 3 years and is expected to grow steadily over the next few years as well. This is providing a cushion to price-to-earning valuations despite all-time high levels. Valuations, on the basis of enterprise value and cash flow from operations, continue to show further scope for re-rating, also given that cost of capital is expected to trend lower in the coming years. On a market cap to GDP basis, India is reasonably valued. India is a bright spot from a GDP growth perspective. FIIs are staging a comeback this year. For the headline indices, the valuations are more attractive than their previous peak. When we look at the broader universe of 1,000 companies, the valuations are more attractive than at previous peak. For the top 500 companies, ex-financials, the aggregate PE looks high since financials have relatively lower PE. Cash flow from operations is a true measure of profitability and efficiency. Since the previous market peak in 2021, the aggregate CFO has risen much faster than stock prices, validating that companies are getting more efficient. EV, CFO shows scope for re-rating given that cost of capital is likely to trend lower in the next few years. Nifty 50 earnings growth is expected to grow at a steady pace going forward. As per the temperature gauge index, valuations are still in fair value zone. For incremental investments, we continue to suggest 50% deployment immediately and 50% to be staggered over 3 months while being able to accelerate deployment during sharp corrections. Based on trailing 12 months earnings, temperature gauge index suggests that large cap valuations are still in fair zone. We maintain a bias towards multi-cap and select mid and small cap strategies across MF, PMS and AIF platforms. Flatness in yield curve continues on account of monetary policy tightening, normalization of liquidity and global factors. The sweet spot lies between 3 to 5 years maturity. We suggest that around 65 to 70% of the fixed income portfolio should be allocated equally to 3 to 5 year maturity high-quality GSEC, or AAA equivalent accrual debt funds and equity savings funds. To enhance the yield, 30 to 35% of the overall fixed income portfolio can be allocated to REITs, InvITs, select high-yield and CDs, and private credit strategies. For liquidity management, or temporary parking, investments can be allocated to arbitrage, ultra-short-term, liquid or overnight strategies. Central banks have increased the net purchase in gold over the last 2 years. Gold is likely to range between $1,830 to $1,850, on the lower side to $2,100 at the top.